countries were distant. Well, that ended around 1992. Deng Xiaoping did what he called the Southern Tour, where he reaffirmed China's commitment to capitalist principles. They weren't overthrowing communism, but they were embracing capitalist market ideas. There was a thaw in U.S. relations, and then it was like, no holds barred. Then that's when the U.S. investment really did pour in. So all in a short period between 1989 and 1992, you had the fall of the Berlin Wall, the fall of the Soviet Union, new republics. China kind of re-enters the game, and all this was globalization. So now all of a sudden you had the science I described, computing and artificial intelligence and applied math, and a true global market. So now the supply chains could go 9,000 miles from Chongqing to New York, or from Shanghai to Seattle, or London to Hong Kong, of course. So this was true globalization, much larger scale, much longer supply chains, and it worked. And so this was a period I call supply chain 1.0, 30-year period from 1989 to 2019. Now, why did it break down around 2019? Three things. A lot of people look at the pandemic and they go, oh yeah, COVID, that disrupted everything. That was the problem. And some people look at the war in Ukraine and the Russian sanctions and go, that was the problem. And they both made it worse. They both made it worse, no doubt about it, made the supply chain worse. But it really started in 2018 with Trump's tariffs on China. So Trump put tariffs on appliances and solar panels. Well, China didn't stand still for that. So China said, well, what can we do to strike back? Well, at the time, China was and is the world's largest importer of soybeans. They need the protein. They don't have enough. The U.S. and Brazil are the two largest exporters of soybeans. Well, China was buying all their soybeans from the United States because they were trying to reduce the trade deficit. We were buying so much stuff from them, and China said, well, what can we buy from the U.S. just to kind of balance the books a little bit? And the answer was soybeans. Well, when Trump put the tariffs on, China redirected all of their soybean orders to Brazil. They stopped buying U.S. soybeans and they bought them all from Brazil. Well, there's a lot more to that than a phone call. You got vessels and dry bulk carriers and transportation lanes and port facilities. And, if you're Brazil and you get all these orders, you got to get trucks to get the soybeans to the ports. You got to open up port facilities, et cetera. The point is, this is a major, major shift in global logistics, just to change the order book from the U.S. to Brazil. Beyond that, people involved in this, they don't want 6-month contracts. They want 5-year contracts, or at least 3-year contracts, and they got them. And so now all of a sudden, China's buying all their soybeans from Brazil, but this scrambled global supply chains. Now, what are the U.S. farmers doing? We're still growing the soybeans. We can't sell them to China. Well, it turns out the Netherlands needed them. So, okay, we'll sell them to the Netherlands and distribute them to Europe, which they did. And then this went on and on because Trump put more tariffs on to retaliate. China took more actions against the United States, canceled purchase. So, and it escalated from there. Now, again, COVID made it worse. The war in Ukraine made it worse. But it's very clear that that's where it started. So that's why I use 2019 as just, kind of an arbitrary date with a 30-year period of supply chain 1.0. Now we're getting to supply chain 2.0, but we're not there yet. We're in this like messy, in between, inefficient, muddling through period where things are broken, but they'll never be put back together the way they were, but we haven't produced or created the new model supply chain. We're just muddling through, and with a lot of disruption, a lot of empty shelves. You have to understand, it took us 30 years to build this. We blew it up in about 3 years. It's not going to come back overnight. It's going to take 5 or 10 years or maybe longer to rebuild in some form. Now, there's another problem. It's even scarier, and this is a central banker's worst nightmare. I talked about how the Fed is blundering because they're raising rates too high, too fast, et cetera, and they are. But the Fed has always said, we don't worry about inflation. We don't like it, but we know how to get rid of it. We just raise rates, and maybe they got to raise them longer and further than people expect, and maybe it's painful, there are costs involved, but they can kill inflation just by raising rates. They don't know how to stop deflation. I mean, how do you stop deflation? Can't raise rates. That'll make it worse. You can go to zero, but that doesn't, once you're at zero, you're at zero. QE doesn't work, by the way. It's been tried to the tune of like $9 trillion, but the empirical evidence is that it's just They do QE by buying bonds from the banks, and the banks take the money and give it back to the Fed as excess reserves. That money never goes to the economy. What good does that do? And the answer is it doesn't do any good. So you can take rates to zero, but you're stuck. Could you have negative interest rates? In theory, yes. In Europe, Switzerland, and Japan did. But there's no evidence that it provided any stimulus. I mean, they did it, but it's like an experiment that didn't work. The problem with deflation is there's nothing a central bank can do, and it does feed on itself, and it does get worse, and that is a central banker's worst nightmare. However, a quick footnote, we did see this in the 1930s, well, between 1929 and 1933, during the first phase of the Great Depression. It was the Hoover administration. Then Franklin Roosevelt came in 1933. And Roosevelt faced exactly the same problem. I mean, he shut every bank in America on like his second or third day in office. By executive order, he closed every bank in America. Can you imagine the President of the United States today? I don't care if it's, Biden or Trump or anybody else, Democrat or Republican, issuing an order saying every bank is closed as of now. We'll get back to you when they're going to reopen. And that's what FDR did. To break the banking panic, but he still had the deflation problem, and the Fed couldn't do anything. I talked to Ben Bernanke about this personally because Bernanke wrote a book on this, and I read the book, and I said, Mr. Chairman, I said, here's what I think you said. Did I get this right? And he said, yeah, that's it. You understand it correctly. But the Fed couldn't and didn't do anything. So how did FDR break the back of deflation when the central banks were powerless? The answer is he raised the price of gold. He devalued the dollar against gold and raised the price of gold 75% from $20 an ounce to $35 an ounce. And that worked because it wasn't about rewarding holders of gold. In fact, he had confiscated all the gold beforehand, so it was like insider trading. But the idea of raising the price of gold was really to devalue the dollar so you could get the price of corn, wheat, steel, oil, get the price of everything else up. And it worked. In the middle of the Great Depression, from 1933 to 1936, the market boomed. I mean, the economy did very well, but it was starting from such a low level. It was still depressed, but it did much better. The Democratic theme song was Happy Days Are Here Again. Then in 1937, the Fed screwed it up again and caused a second recession in the Great Depression. And that's why they call it the Great Depression. But the devaluation of the dollar against gold worked. Nothing the central bank could do would work. Deflation is very troubling and should be to central bankers, economists, and everyday citizens, everyday Americans, because it raises real interest rates really steeply. It feeds on itself, and there's nothing central banks can do about it. And the only thing that has ever worked is devaluing the dollar against gold. So that's one reason to have gold. But we're looking at a global recession. And those are rare. As I said before, it's one thing if Germany has a recession or Japan or the US, but usually there's another economy or economic group that's doing okay or at least better and can kind of pull everybody out of the rut. But global recessions where everybody is declining are rare. And that's what's happening. And that's what we had in 2008. So the U.S. is heading for one. We've just talked about that at length. Japan's in a recession. Europe's in a recession. China's in a recession. India's, having some tough times. And a lot of this is dollar related. All the other countries I mentioned, Switzerland, India, China, Japan, have all seen their US dollar reserves go down. And everyone's like, oh, they hate the dollar. They're dumping the dollar. No, it's the opposite. They don't have enough dollars. So they're selling treasuries to get dollars to bail out their own banks because there's a dollar shortage. So the fact that you see those dollar reserves coming down does not mean that they hate the dollar. It means that they need dollars, that they're short of dollars, and they're so desperate that they are selling treasury securities to get dollars to bail out their own banking systems. So we're well on the way to a global recession. And if you say, well, you got communism, socialism, capitalism, all these different economic systems, all part of this globalized system, how could they all be on the same wavelength at the same time? Well, the common thread is the dollar. It's the US dollar. About 60% of global reserves, 80% of global payments. It's the benchmark for every other currency. So when you talk about the euro, you're quoting dollars. You're saying it's $1.05 or $1.04. Gold, you say, oh, it's $1,800 an ounce, whatever. The point being, even when you're talking about a commodity or currency that's not a dollar per se, you reference it in dollars. Same with oil, world market, it's all dollar oriented. So the dollar is the thread that runs through the whole global system. And it's a partial explanation for why everything's falling apart at once. What's the optimal asset allocation method? Well, the key is diversification. And when you say diversification, people roll their eyes and go, oh, of course, everybody knows that diversification is good and all that. But the problem is they don't understand what diversification is. And I run into people all the time and they go, Jim, I'm highly diversified. I own 50 different stocks in 10 different sectors, telecommunications, semiconductors, mines and minerals, consumer non-durables. So I'm highly diversified. And I say, no, you're not. You may have 50 stocks, but you have one asset class, which is stocks. And they're all going to go down together or go up together as the case may be. But particularly in times of stress, they become highly correlated. So having 50 different stocks or ETFs or whatever is not diversification. That's just having a whole bunch of bets in one asset class. So what does real diversification look like? Well, you should have some, 10-year treasury notes, or if they're a little too volatile for your taste, look at a 5-year note or a 2-year note. That will basically give you very, the credit secure. I'm not doubting the credit of the United States, but that will give you a deflationary hedge. If we get into disinflation and deflation where interest rates are coming down, which I do expect, you're going to get very good capital gains on those notes, or you're going to be very happy with the coupon in the meantime. Real estate, definitely. Not so much commercial real estate, too soon for that, but multifamily housing, residential real estate, farms, other kinds of income producing real estate for a slice. Good slice of cash, maybe as much as 30%. People hate cash. They go, I don't get a yield on cash. Cash is a waste of my time, etc. It's true that it has very low yield, but number one, it performs very well in deflation, which we talked about. But more importantly, cash is the opposite of leverage. It reduces the volatility of the rest of your portfolio. So if you have volatile investments in the wings, cash is it's like a bar connecting to two ends of the barbell. It has very low volatility, but most importantly, it gives you optionality. If you see stock markets crashing and burning the way I expect, the way I described, the person with cash can go out and go shopping in the ruins. And by the way, Warren Buffett Berkshire Hathaway has over $130 billion in cash. Why does Buffett have so much cash? Well, he sees what I see. We're looking at the same thing, which is a kind of meltdown where the person with cash can basically go shopping for bargains. Definitely a slice of gold for the reasons we talked about. That'll be your inflation hedge. But 10%, people always say, Jim Rickards says, sell everything and buy gold. I've never said that. I don't think that's a good idea. But 10%, yes, that's a good slice. Private equity, if you can have access to good deals, that's a separate category. And so a model portfolio, you'd have a slice of treasury notes, a slice of cash, have some stocks, but I would focus on, for example, energy, BP, Exxon, Mobil, Shell, Marathon, this green new scam thing, forget it. It's a big deal, from a policy point of view, but it's infeasible. I've studied the science very closely. It's going to go away. But in the meantime, if you bash the oil and natural gas companies, but you're going to need the oil and natural gas, which we do, then those stocks are going to do well. Real estate, I mentioned, and gold. So that would be a really diverse portfolio that would have 5 or 6 different asset classes. And some will outperform others. Some will do better in inflation, some will do better in disinflation. But that's the whole idea with this much uncertainty. And your winners will outnumber your losers. And cash is like a thermostat. You can reduce cash and buy a little more gold, or reduce cash and buy a few more stocks if that's warranted. So that's what I think an ideal portfolio is. The future is very positive for gold. You have the normal vectors. Supply is flat, but has been for 6 years. Demand is going up. Central banks have flipped from net sellers to net buyers. That's a big deal. Retail and institutional interest is higher, so that's good. Geopolitical threats, don't need to say a lot. From the U.S. perspective, Iran, China, North Korea, Venezuela, Russia, you name it. So that's the vector. But the biggest driver right now is what I referred to a few minutes ago: negative real rates. Because gold, as a form of money, which is how I view it, competes with other competes with other instruments, treasury bills, et cetera. Well, if they have high yields and gold has no yield, you want the treasury bills. But if interest rates have negative yields and gold's just flat, gold looks more attractive. So that's the main driver, and that's going to continue. everyone's like, well, the gold is up, gold is down. So what do you mean when you say that? And they're talking about the dollar price of gold. And it's like, okay, so the dollar price of gold is up or down. That's really a cross rate. That's no different than talking about the euro US dollar exchange rate or Australian dollar US dollar exchange rate. If you think of gold as money, and I do, then the dollar price of gold, with gold measured by weight, not as another currency, it is another form of money, but with gold measured by weight, it's a cross exchange rate. When the price goes up, I would say that what's really happening is the dollar is going down. In other words, I think of gold by weight. I'm interested, do you have a ton? Do you have 50 kilos? Do you have 5 ounces? Whatever you have as an individual investor, as a bank, I think of it by weight. Because when someone says gold's really going up, I said, well, no, the dollar's going down. You need more dollars to purchase a fixed quantity of gold, which means the dollar's worth less. And when people say gold's really going down, I say, no, the dollar's worth more, and you need fewer dollars to purchase a quantity of gold. When people talk about price, the first thing they do is they're really talking about dollars. There's a euro price for gold, but the world market is based on dollars. You're privileging the dollar as the numeraire. The numeraire is your counting system. Is it yards, inches, feet, whatever? And if you put the dollar first and say gold is in dollars and it's going up or down, I think you have it backwards. I think you need to put gold first by weight. And then if it's worth more, the dollar's going down. If it's worth less, the dollar's going up. And so when you say gold is going up, let's say it went to $2,000 an ounce, everyone say, oh, the price of gold went up, just went up 10%. Well, did it, or did the dollar go down? The way I would phrase it is, it used to be $1,800 to get an ounce of gold. Now it's $2,000 to get an ounce of gold, or, your dollar got you 1/1800th of an ounce. Today, it only gets you 1/2000th of an ounce. In other words, gold didn't do anything. It's a metal, it's an element, atomic number 79. What happened was the dollar got stronger. So a stronger dollar is a lower dollar price for gold, and a weaker dollar is a higher dollar price for gold. So when people talk about gold going up, what they're really talking about is the dollar going down.
We have new numbers regarding how much gold central banks are buying, 400 tons in Q3 this year, records and numbers we haven't seen since the 80s. Yet we don't know some of those mystery buyers. Obviously, the theories are they are Russia and China.
Now China's non-transparent. Russia is much more transparent, although Russia is starting to be opaque a little bit because they're in a war. But you can see the inflection point is 2010. So from 1970 to 2010, it's a long stretch, 40 years, central banks were net sellers. It didn't mean everybody sold everything, but Switzerland's down 1,000 tons, US was down 1,000 tons after losing 8,000 tons, 11,000 tons between 1950 and 1970. It was down. 2010 was the year that central banks became net buyers. Now, it doesn't mean every central bank was buying gold. It does mean that they were selling a lot less and others were buying more. And some of the buyers are Mexico, Kazakhstan, Philippines, Vietnam. We know China's a big buyer. We don't know exactly how much. Russia was a big buyer. That is continuing. Now the new players, Iran's non-transparent, but we know they're buying gold. Turkey is buying a lot of gold. Japan had a bunch of gold all along. They never told anybody about. Literally in 1 month, their reserves went from 600 tons to 900 tons. Well, the market. You can't buy 300 tons in a month, not one country in one order. But they had it all along, but they decided to reveal it, put it on their balance sheet. So Americans don't seem to like gold. I'm not sure Canadians feel much differently, or others around the world. But central banks sure do, and I think that tells you something. There's huge demand for dollars all over the world, not because of the currency, but because of collateral, because of treasury bills. Banks need treasury bills to pledge as collateral for derivatives. It's the best collateral in the world. And if you don't have it, you're not going to be able to leverage your balance sheet as much as you would like. You're not going to be as profitable. You're not going to be able to support lending and investing, which is what banks in theory are supposed to do. To support the bloated balance sheets and to support the derivatives, you need collateral. And the better the collateral, the more leverage you can have. The best collateral in the world is a treasury bill. And so there's a mad scramble for treasury bills, which means there's a mad scramble for dollars to buy treasury bills. And that is coming from European banks, it's coming from Chinese banks, and banks around the world, but primarily European and Chinese. And that's not going away. So it's funny to hear people, or people think it's funny to hear anyone talk about a dollar collateral shortage, like, hey, haven't you flooded the world with dollars? Hasn't the Fed printed $9 trillion? And the answer is they have. But that's not the measure. It's a high multiple of that. It's the dollar value of all the collateral. Because in the repo markets, I pledge the collateral to you, and then you pledge it to somebody else, one of our colleagues, and then she pledges it to somebody else, et cetera. That collateral gets pledged 50 times and supports not $1 a balance sheet, but $50 a balance sheet for $1 of collateral. And so you restrict the collateral, you're restricting the balance sheet. The dollar as a reserve currency will not be deposed overnight, but as a payment currency, there's a difference between a reserve currency and a payment currency. Anything can be a payment currency. If I want to pay you with baseball cards and bottle caps and you're okay with that, then it's a currency. So all of these organizations are working on new payment systems right now, and they're going to start to roll them out this year and later. So that's going to be a radical change in how we pay for things. I can give you 20 reasons why the dollar should go down, but I'll give you one big reason why it won't, which is the demand for collateral. And so that's keeping the dollar constant, which is keeping the dollar price of gold constant, because gold doesn't change and the dollar's not changing. Now that'll break, and that'll break in favor of gold, meaning the dollar will get a lot weaker. It'll have to, but it's going to take a few months at least, because the U.S. economy has to get weaker, which it is. The Fed will figure this out maybe by September, next September. And then they'll ease a little bit and they'll try to weaken the dollar to try to give the U.S. economy a boost. But we're not there yet. So it's going to be, now that doesn't mean the price of gold is going down a lot. I'm just saying it's not going to go up a lot. It's going to chug along kind of sideways. But when it breaks, it's going to break big to the upside, because the dollar is going to go to the downside. But that's probably at least still a few months away, maybe longer. Just at a very high level, I would say that there are a lot of difficulties, a lot of challenges. We'll talk about all of them in detail. People put words in your mouth and kind of get the reputation as this doom and gloom guy. Jim Rickards is always talking about the end of the world, which I don't. I never use that expression. But I make the point that, despite the difficulties, we don't have to be victims. We're not helpless. We don't have to curl up in a ball. The key is to see it coming. If you can see things coming, you can deal with them accordingly. You can get through them, not only preserve wealth, but actually make money. I always point out the example of Hugo Stinnes, and people go, who's that? He was an industrialist in Weimar, Germany in the early 1920s, and he could see the hyperinflation coming long before the middle class, long before anybody else. He went out and borrowed an enormous amount of Reichsmarks, that was the currency at the time, and just bought industrial assets, coal mines, vessels, natural resources, etc. So here comes the hyperinflation. He gives it a little time. He pays back his debts. I would say pennies on the dollar, like a millionth of a penny on the dollar, in other words. But he paid it back. They were sweeping the money down the sewers, but he paid back his debts and kept all the assets. And he became the richest man in Germany. And my German's not very good, but his nickname was Inflationskönig, which means the inflation king. So there are other stories like it, Joseph Kennedy in the 1929 crash. But here's a guy who lived through the greatest hyperinflation of any modern industrial economy and ended up as the richest man in Germany because he saw it coming and made the right move. So again, we're not helpless. We can do things about it. But the key to empowerment, as I say, is to see it coming. That's where the analysis comes in. And you're like, Jim, are you smarter than everybody else? Of course not. There are a lot of big brains around, but people have flawed models. There's a lot of behavioral psychology behind it, the confirmation bias, or believing the future will resemble the past, which it usually does not. And so if you're going to stick to those models, you're going to get really bad results. It's hard to think of an institution that has a worse forecasting record than the Federal Reserve, the U.S. Federal Reserve, with the possible exception of the IMF. They're both pretty bad. I mean, you could almost take the Fed forecast, do the opposite, and be just fine. There's more to it than that, but they just stick to these really bad models. But if you understand how the economy really works, if you understand it's a complex dynamic system, all I've done is I've taken complexity theory, which has been around for a while. I mean, you can say 13 billion years because the Big Bang was the ultimate complex dynamic paradigm shift or phase transition. But the science of complexity, understood in mathematical terms, really dates to the early 60s. but it's been used very successfully in physics. It has a lot of applications. All I did was bring it over to capital markets. I looked at capital markets and said, wait a second, here's one of the most complex dynamic systems you can picture. And then there's nothing more complex than the human brain. So you're putting humans on top of capital markets. You've got complexity squared or some exponent. And those models work brilliantly. But try getting anyone to understand it or do that work is difficult. But again, the point is, if you have the right models, and I would include behavioral psychology, a good dose of history, complexity theory, and a few other branches of applied mathematics, you can get very good results. But if you stick to, the Phillips curve and non-accelerating inflation, unemployment rate, and a lot of other nonsense the Fed uses, you're gonna get it wrong. Does the future resemble the past? With some probability, some degree of distribution probability. Not always. I mean, and maybe less frequently now than ever. And they also assume that prices move continuously. Yeah, prices go up and down, of course, but markets don't move continuously. Or if they do, it's when you don't care. When you do care, they just gap. They gap down or they gap up. You miss it, you blink, and it's at a completely different level. It's been repriced. Now, you can still get in and out, but you've either made a lot of money or lost a lot of money, in the blink of an eye. So when you take those characteristics, and this is how I started kind of, deconstructing it, if you will, and said, well, look, markets are not efficient. That's nonsense. They don't move continuously and slowly. They gap up and they gap down. And if you're not ready for that, you've missed the boat. Nothing's risk-free. So why don't we start there? When I started identifying those factors that, in my view, were incorrectly applied, and you say, well, what looks like that? Well, the answer is a complex dynamic system. A system that produces hurricanes and tornadoes and lightning bolts and power outages and earthquakes and tsunamis. Those are all examples of the results of complex dynamic systems. An earthquake doesn't sneak up on you. It just the ground falls out from under you instantly. And that's what happens in markets. So then I said, well, maybe that's a better model. Of course, it is. Things evolve all the time. Another tool, intellectual tool, applied mathematical tool uses Bayes' theorem without getting too much in the weeds. And I learned Bayes' theorem at the CIA because I always say, if you have all the facts, a smart high school kid can solve the problem. The intelligence agencies and others, and people in capital markets, have to solve problems when you don't have all the facts. But you have no choice. In national security or defense, it's literally life or death. On Wall Street, it could be your fortune or your client's fortune. So you don't have the luxury of just throwing up your hands and say, "Well, I'm going to wait till I get more facts." That's what Janet Yellen did, but that doesn't work in the real world. She's kind of detached from that. So how do you solve problems when you don't have all the facts you need to really solve the problem, and you know it, but you have to deal with it anyway because it's coming at you? Well, Bayes' theorem says assign an initial probability, a priori assumption. Just not make it up, but do the best you can, recognizing that you're going to fall short, that you've got missing pieces in the puzzle, if you want to put it that way. And if you have no facts at all, and it's a binary outcome, give it 50-50. It's like, it's not quite 50-50, but red or black on a roulette table, it's a little less than 50-50. It was close enough. He said, it's either going to be red or black, don't know which. I'm going to give it a 50-50. And then what you do, this is what statisticians hate, you update it based on subsequent facts. As new facts come in, you put them back in the model, you update it, and what you'll discover is that your probability either goes up or down. Well, if it goes down more than a certain amount, you discard it. You say, well, that's wrong. I just do it again. But if it goes up, what you're doing is making it more and more likely that your assumption was true. And so eventually you can get up to the 80-90% level. And that's not 100%, but it's pretty darn good. But there's a tension, which is, okay, as you're updating, and this is something that was explained to me by Henry Kissinger. So imagine a simple graph, and the vertical axis, the y-axis, is the probability of a certain outcome, and the x-axis is a timeline. Basically, you convert that into the amount of information you have. How much information do I have? How much time do I have to make a decision? Well, at zero, at the outset, you have no information, or very little. But you have a lot of time. You have a lot of degrees of freedom. But as you move across the x-axis, as you move down the timeline, what you discover is you get more and more information, which is a good thing. So that curve is going up. But you have less and less time, fewer degrees of freedom. That curve is going down. So when you get all the way to the other end, it's like, hey, I have perfect information, but it's too late. It's over. I miss either, war started or I lost all my money or something bad happened. So what you look for is the sweet spot in the middle, call it the Kissinger cross, where I have enough information to be smart, but enough time to have degrees of freedom and be able to act. You look for that sweet spot in the middle, and that's when you act. And, with a little humility is a very good tool, a good addition to the. They, $9 trillion of QE didn't do any good. I mean, how does the Fed do QE? They buy bonds from banks, give the money to the banks, and the banks give it back to the Fed as excess reserves. What does that do for the economy? Nothing. Zero rates, again, it doesn't work. They don't have the tools. We've been talking about recession, inflation, deflation, but the one thing we haven't spoken about yet, you kind of just referred to it, is there a global liquidity crisis coming? And a liquidity financial crisis is different from a recession. Sometimes you can have one without the other. In 1990 we had a recession, there was no crisis. 1998 we had a crisis, there was no recession. The economy was fine in 1998, but the financial world almost came to an end. Sometimes they come together, and that's what happened in 2008. We may be looking at a scenario like that. By the way, 65 trillion in foreign currency derivatives, yeah, but try 1 quadrillion in total derivatives. I mean, that's foreign currency. That was the focus of the BIS paper. But when you get into interest rate swaps and commodity swaps and swaptions and all the rest, that's 1 quadrillion, which for people not familiar with the Q word, is 1,000 trillion. So you pointed to 65 trillion, and you're right, that's FX, but there's 1,000 trillion or 1 quadrillion of derivatives off balance sheet of the banking system, supported by collateral, a little sliver of collateral, and there's a dollar shortage, and that's getting ready to implode. Well, a couple things you can do. One thing, I would increase my cash allocation. A lot of people hate cash. They're like, it doesn't have any yield. Why would I do that? I'm missing out on whatever, Bitcoin or stocks or whatever. Cash is extremely valuable. Number one, it performs very well in disinflation and deflation. Deflation, it could be even with a very low nominal yield, it could have a much higher real yield in the world where prices are going down. So it's a good deflation hedge. But more importantly, cash gives you optionality. If taking everything we just described about a potential stock market crash that could be 30% or more, a global liquidity crisis that could be worse than 2008. I mean, there are plenty of signs of both of those things. Well, if you're the one with cash, first of all, you're not going to lose money on cash. You will on stocks and other asset classes, but not cash. And then when this drawdown comes, when this collapse comes, you're the one who can go shopping. You can go out in the wreckage and say, oh, well, here's a good company. It's down 90%. I'll buy some of that. By the way, the person with the most cash in the world is Warren Buffett. Berkshire Hathaway has over $130 billion of cash. Now, why do they have that? The answer is Buffett sees the same thing I see, the same thing we're talking about right now, which is in a highly uncertain world with a lot of vulnerabilities, that's exactly what we're describing, that come home to roost, and that's how I see 2023. Cash will preserve wealth and then give you the opportunity to pick up bargains. I'd also have a slice of gold. I recommend 10%. People always want to put words in your mouth. Jim Rickards says, sell everything and buy gold. I've never said that. I don't think it's a good strategy. 10%, yes. Now, if you have 10%, sit tight. It'll serve you well. If you don't, you might want to get some gold, because a lot of what we're talking about is going to play out in foreign exchange markets. In crypto, there's nothing there, but they've replicated this infrastructure. And so a lot of the wealth that's been generated in crypto is because you own a crypto exchange, or you own a lender site. Now that's all imploding. It's kind of a replay of 2008, except instead of Bear Stearns, Lehman Brothers, Fannie Mae, Freddie Mac, and Morgan Stanley was hanging by a thread. It's FTX most prominently, but Genesis is kind of considering bankruptcy, etc. So all that is collapsing. So Bitcoin's not an exchange. It's not part of that infrastructure. It's just a coin. The best analogy I've been able to come up with, I have a lot more to say about it coming out of communications theory, but it's like a casino chip. If I walk into a casino, put my money on the roulette table, and the croupier gives me chips, I can gamble them, I can play with them, I can make money or lose money. But when I leave, I go to the cashier and get my dollars back and walk out. If I take the chips outside the casino, they're worthless. I can't pay for dinner with casino chips. So cryptocurrencies are casino chips. You're in the crypto casino. Some people made a lot of money, and I know some of them personally. A lot of people have lost a lot of money. More have lost than made money, which is how casinos work, by the way. So eventually they'll all go to zero, but in stages. But what's collapsing right now is the infrastructure. China's non-transparent. Russia is much more transparent, although Russia is starting to be opaque a little bit because they're in a war. But you can see the inflection point is 2010. So from 1970 to 2010, it's a long stretch, 40 years, central banks were net sellers. It didn't mean everybody sold everything, but Switzerland's down 1,000 tons, the U.S. was down 1,000 tons after losing 8,000 tons, or sorry, 11,000 tons between 1950 and 1970. It was down, down, down. 2010 was the year that central banks became net buyers. Now, it doesn't mean every central bank was buying gold. It does mean that they were selling a lot less and others were buying more. And some of the buyers are Mexico, Kazakhstan, Philippines, Vietnam. We know China's a big buyer. We don't know exactly how much. Russia was a big buyer. That is continuing. Now the new players, Iran's non-transparent, but we know they're buying gold. Turkey is buying a lot of gold. Japan had a bunch of gold all along. They never told anybody about. Literally in 1 month, their reserves went from 600 tons to 900 tons. Well, you know the market. You can't buy 300 tons in a month, not one country in one order. But they had it all along, but they decided to reveal it, put it on their balance sheet. So Americans don't seem to like gold. I'm not sure Canadians feel much differently, or others around the world. But central banks sure do, and I think that tells you something. They're preparing for what we're talking about, which is a world where the dollar as a reserve currency will not be deposed overnight. But as a payment currency, there's a difference between a reserve currency and a payment currency. Anything can be a payment currency. If I want to pay you with baseball cards and bottle caps and you're okay with that, then it's a currency. So when we see the BRICS Plus, the Shanghai Cooperation Organization, OPEC Plus, China individually, all these countries are the Eurasian Economic Union, which is Putin's answer to the EU. All of these organizations are working on new payment systems right now, and they're going to start to roll them out this year and later. So that's going to be a radical change in how we pay for things. The thing is, people don't understand reserve currency. It's not as if the People's Bank of China has pallets of $100 bills stacked up in the basement. Reserve currency means a currency of denomination of securities. So what China does have are treasury bills and treasury notes. So the key to being reserve currency is not the currency, it's the bond market. Do you have a large, safe, liquid bond market? And if you do, then people will buy those bonds. What else are they going to do with the money? But that's much harder to replicate. Well, they can't have a currency backed by gold, at least not the Chinese yuan, because the problem is there is no Chinese yuan bond market of any size, number one. Number two, they have no rule of law. I mean, no, I wouldn't trust the Chinese or the Russians for that matter. And the U.S., the problem with the U.S. is that we had a good thing going. I've always said the world will not destroy the dollar. The United States will destroy the dollar through our own policy blunders. And when you freeze the assets of the Central Bank of Russia, I don't want to debate the war in Ukraine, that's a big subject, but when we freeze the assets of the Central Bank in Russia, and you're the Central Bank of Turkey, Saudi Arabia, China, you're like, hey, how do I know that next week the U.S. isn't going to not like something I did? Are they going to freeze my assets? So little by little, yeah, at the margin, you get out of. The Silicon Valley Bank was taken over by the regulators on March 10th, but you can see it coming. It was in distress. There was $40 billion pulled out of that bank in one day on Thursday, March 9th, the day before it was taken over. $40 billion just hit the road, just left. It was a complete collapse. And then you get all the corruption, insiders selling stock before the crash. Mary Daly, the chief regulator, president of the Federal Reserve Bank in New York, she's running around doing LMNOP plus and pride flag and all this stuff. Fine, that's it's a free country. You can do that if you like, but she wasn't running the bank, and she knows nothing about risk management. She's a labor economist, protege of Janet Yellen, came up the ranks, but knows nothing about risk management or actually running a bank. So it just got worse, and then here comes Credit Suisse, right? The entities are always different, the currencies are always different, but the dynamics are very much the same. And the one thing I can say to our viewers is that this is not over. There's been a little bit of a sigh of relief. Stock market rallied a little bit toward the end of beginning of April. And okay, that's a normal reaction. But any thought that the problem's been solved, the bailout's complete, you're not going to hear more, is just not true. There's more coming. Get ready for it. I'm just saying that there are more dominoes waiting to fall.
As you may have noticed, as we're going into a recession, and I suspect unemployment's going to scream. I see more people here in Arizona standing on street corners and all this saying, you know, veteran, please give me $1 or something like this. And I just can't believe they're wasting their time begging for money. And this guy was a pretty young guy standing on the corner begging. And it's not good. So we're heading back, I think, into the 1920s. Very good chance we're in the middle of a drought right now. This is a 90-year cycle in bad weather.
The really interesting part about this, and again, we can come back to the specifics, is that the dominoes falling is a good metaphor. It's, you know, if you got 100 dominoes, you knock the first one, they're all going to fall. That's just physics. So how do you stop that? How do you stop that crisis? Well, you truncate, you drop a steel wall between two dominoes, and this one hits the wall and this one's still standing. But that's the bailout. But the problem is each crisis tends to get bigger than the one before, which means each bailout gets bigger than the one before. My question that I'm wrestling with, are we now at the point where the needed bailout is bigger than the capacity of the central banks?
Today, everything's changing so rapidly, but this time the tom-tom beats are getting louder and louder and more do it now, basically. My concern today is for Kim and I, our real issue is social unrest. You know, the gap between the rich and poor is now excessive. And that leads to revolution, civil rioting, and all this. When you print all this fake money and you rig it for the rich only, what that produces is a wave of intensified and widespread social unrest, disjointed political upheaval, dangerous extremism, punishing trade wars, and sweeping isolation.
The crash we see is in the commercial business sector. Again, the higher interest rates go, the more money people have to pay on their loans, particularly if they're variable, which, by the way, just happened up in Canada. They got a lot of variable interest rates up there, and they just raised the interest rate there 50 basis points. So we believe, we're forecasting, the big downturn is going to happen in 2023. It takes time for this stuff to take hold. But then don't worry about it, because when 2024 comes, they're going to lower interest rates in the United States in time for the presidential reality show.
The most important thing today are credible sources. And now the alarm is getting louder as technology changes. We have to go to a solution pretty quickly because people are on suicide watch right now. Well, first of all, everybody can do something, but they won't. And that's the problem. The reason, who stole my pension, there was plenty of money in it, but nobody did anything. They just stole it. The people did nothing. It's like I said, when the crash came in 2008, not one of those guys went to jail. They got paid bonuses. So there's something rotten inside America. And I think the problem with many Americans is they're complacent. They expect, well, it'll heal itself again.
The higher these interest rates go, all the people with adjustable rate mortgages, all the businesses that borrow money that have variable rate mortgages, the governments that are deep in debt now paying more because interest rates are going up. So yeah, the equities are going to go up, but this economy is going to keep going down. And it's going to go down big, and it's going to go down hard. Not right away, but it's going to progressively get worse and worse and worse. UK traders now expect the BOE's next rate rise to be its last in the cycle. And in the Eurozone, markets expect rates to peak at 3.25% in the summer, up from the current level of 2.5%. 2.5% when you're looking at inflation rates in the UK and the EU that are killing the people. These interest rates are nothing compared to inflation. So when you put the inflation numbers compared to the interest rates are still deep in negative territory. It will prop up the equity markets, but the economies are going to go down.
The question I ask people is, if we go into a depression, how will it be? That's the question. So I set it up since 1971 when I saw Nixon take the dollar off the gold standard, and I started getting smarter. So I'd say, I don't trust my government. Like, don't fight the Fed. And I was like, can the Fed print oil? Can it print gold? Can it print water? Can it print food? No. But people go, oh, don't fight the Fed. So the thing I always say is, in a worst case scenario, how will you do? So that's why I own oil wells, not oil stocks. I own cattle for the food. I own gold mines. I own my own company. My company, Rich Dad, did better in the downturn than ever before. So it's not recession-proof, but people wake up more and they say, I better get financially educated. And I never stop studying. It's the most important thing you can do. Problem with Americans is we're dysfunctionally optimistic. We live in a don't worry, be happy world. And that's not the real world.
So now we're dangerously close to the point where, as the crisis gets worse, it's no longer, oh, gee, let's wait for the Fed to bail it out, or let's wait for the ECB to bail it out. You get to the point, I think we're there, where you say, no, these guys actually can't stop it. And you lose confidence in the currency itself. The crisis is the dollar itself, and there's no way to bail out a dollar crisis.
By Jim Rickards, a renowned financial analyst, discussing the ongoing banking crisis and its root causes. He sheds light on the chain of events that began with the failure of banks involved in both traditional and crypto finance. The story unfolds from March 2023, when the FDIC took over Silicon Valley Bank and Silvergate Bank, exposing the precarious state of the financial sector. What's fascinating is the revelation of a bail-in strategy that emerged from the ashes of the 2008 financial crisis. This strategy has far-reaching implications for depositors, investors, and the entire financial system. So let's explore Jim Rickards' insights into this unfolding crisis and how it may affect the broader economy. Jim Rickards starts by asserting that the banking crisis is far from over. He explains that financial crises don't happen suddenly in one catastrophic event. They tend to emerge gradually, with regulators and investors believing they have the situation under control until it resurfaces. The crisis he discusses traces back to a lesser-known bank, Silvergate and Silicon Valley Bank. Jim Rickards highlights the critical link between the crypto world and the traditional banking system. The collapse of cryptocurrencies, such as Bitcoin, in late 2021 served as a warning sign. As Bitcoin's value plummeted from $69,000 to around $13,000 in a year, it raised questions about potential contagion from the crypto market to the banking world. Silvergate Bank played a crucial role as a bridge between cryptocurrencies and fiat money. This dual nature exposed the traditional financial system to the volatile crypto market. Jim Rickards shifts the spotlight to the Silicon Valley Bank crisis, emphasizing the FDIC's response. On March 10, 2023, the FDIC declared Silicon Valley Bank insolvent and announced that only deposits up to $250,000 were insured. For deposits exceeding this amount, depositors received a receivership certificate with an uncertain value. Remarkably, it's revealed that only 3% of the deposits at Silicon Valley Bank were insured, totaling approximately $140 billion. This meant that the majority of depositors were facing significant losses, including big names in Silicon Valley like Roku and Cisco. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
The banking crisis is not over. The crises don't happen all at once in one day. They emerge, regulators deal with them, the other new investors come in, they go, oh, it's all good, we got this under control, and then there's 2 or 3 months of a quiet period, and then they just pop back up again. It's because they were never fixed in the first place. A lot of people think this all started with Silicon Valley Bank, and that was March 10th, 2023, when the FDIC declared them, well, basically took over, put them into receivership. But that's not quite the right starting date. The day before, March 9th, there was another failure. It was Silvergate Bank. not Silicon Valley, but Silvergate. Silvergate failed, basically closed its doors and went bankrupt. And they were an FDIC insured bank. They were a member of the Federal Reserve System, so they weren't some kind of weird, semi-bank or shadow bank or whatever you want to call it. They were a real bank, but they had one foot in the mainstream banking world at the Fed, but they had another foot in the crypto world, and they were actually a portal between crypto and dollars. And you could buy and sell crypto and get dollars. They would credit your account and all that. But when I saw the crypto collapse coming, or not coming, it happened. November 2021, Bitcoin was $69,000. By November 2022, it was down to around $13,000, give or take. So that was a 90+% collapse. And I saw that. I said, well, there's no way this is confined to Bitcoin. And I was right. A lot of crypto exchanges failed. But the question I kept asking myself, is there a danger, and there is a danger, that there'll be contagion from the crypto world to the banking world? That was the question I had, because crypto, it could all go to zero, knock yourself out. But if it goes into the banking world, we got much bigger problems. And it did. And Silvergate was that portal. Okay. Next day, Silicon Valley Bank fails. And the FDIC did a very interesting thing. They did their job. And by that, I mean, they issued a press release. The press release came out at 6 p.m. on Friday, March 10th, 2023. And it said, we are insuring all deposits up to $250,000. That's what we do. But if your deposit is more than that, you're uninsured. We're going to give you what they call a receivership certificate. Hang on to it. We'll get back to you in terms of what it's worth. You can't cash it in. We don't know what it's worth. We will then proceed to sell the assets of the bank, pay off creditors, and if, as and when there's anything left over, we'll distribute that to you on a pro-rata basis. But just hang on. We'll get back to you in terms of what this is worth. Well, it turns out that, of course, this was all known. Just said, look at the data. Silicon Valley Bank only had 3% insured deposits. 97% of the deposits were uninsured, and the amount was approximately $140 billion. And they weren't all like, $2 million A-round startups. You had Roku, Cisco, and other names, big Silicon Valley names that had multi-billion-dollar deposits. And for that matter, one of the crypto exchanges had a $3 billion deposit at Silicon Valley Bank.
In response to the impending crisis, Jim Rickards highlights how high-profile figures, including Bill Ackman and other Silicon Valley billionaires, rushed to the White House, warning that the failure of these banks could have catastrophic consequences for the tech sector. These banks had extended substantial loans to over 200 startups and companies in Silicon Valley. These businesses had payroll obligations, employees, and a significant role in technology development, making their collapse a potential disaster. Within 48 hours, the situation took a dramatic turn. Jim Rickards reveals that the FDIC's initial stance of only insuring deposits up to $250,000 had been reversed. They decided to guarantee all deposits, including multi-billion-dollar ones. This sudden reversal, often referred to as a bail-in, marked a significant policy shift. The FDIC, acting in accordance with their announcement at the 2014 G20 meeting in Brisbane, indicated that depositors and investors would have to bear the responsibility of rescuing the banks before government intervention. Jim Rickards shares a fascinating insight into the White House's decision to step in. Many of the companies being financed by Silicon Valley Bank were in the green technology sector. This alignment with green initiatives played a pivotal role in persuading the government to intervene. While it was commonly assumed that these banks primarily supported tech startups, they had a significant hand in financing green initiatives, particularly in battery technology and wind energy.
So it wasn't clear that they weren't going to fail. I mean, this was contagion and recontagion, if you want to think of it that way. So what happened over the weekend between March 10th and March 12th, all the crybaby billionaires, Bill Ackman, all these guys, they all go running to the White House saying, you don't understand what you're doing here. We got 200 startups in, Silicon Valley. They all got like 3-5 million. They got payrolls, they got employees, they got rent, they got technology development. You're going to destroy the tech sector if you don't bail this out. And so then on 6 o'clock Sunday, just 48 hours after the first sound. By the way, I should add that going back to the Friday announcement, that actually came out of the Brisbane G20 meeting in 2014. In 2014, Brisbane G20, we were still in the aftermath of the 2008-2009 financial crisis. There was an uproar. Citizens were, pardon my language, they were just pissed off. The taxpayers bailed out the banking system and all the billionaires kept their jobs. So Jamie Dimon, he's still collecting bonuses, Goldman Sachs, all of them. None of them failed. They would have failed, but for the fact that they were all bailed out. But the everyday Americans are like, unemployment's 9%. I lost my job. I lost my 401ks down 50%, et cetera. So there was a political reaction to that. So in Brisbane 2014, they came up with not the bailout theory, but the bail-in theory. And bail-in means that if a bank fails, the investors, the stockholders, the bondholders, the depositors, they have to basically pay off the creditors. They have to pay off the depositors, and only when there's nothing left would the government maybe chip in. So what? And they put the world on notice. The insured amount in Europe is 100,000 euros. U.S. is $250,000. But the whole world was on notice. That's all we cover. Over that, you're on your own. Well, what the FDIC did on Friday was actually consistent with what they all said they were going to do in 2014. It was a bail-in, and if you had $1 billion deposit, you're going to contribute to the rescue. Within 48 hours, they did a 180-degree turn. They completely blew away the $250,000 insurance limit. They said, we're guaranteeing all the deposits, multi-billion-dollar deposits. By the way, a dirty little secret about what happened at the White House. I said that, the Silicon Valley billionaires were crying about all these little startups and all this stuff. The truth is, a lot of what Silicon Valley Bank was financing was green technology. They were a climate bank. And of course, that's all you have to say to the White House. Hey, this is green. And oh, yeah. Now, what were they doing? I don't know, battery technology, better windmills. None of that stuff works, by the way. But no. they were in the White House sweet spot by saying green, and they were. That was actually what they were financing. Everyone thinks, oh, somebody's working on an app. They weren't apps. They was like battery power.
Jim Rickards then pivots to another significant event that occurred on March 12, 2023, when Signature Bank, not directly related to Silicon Valley Bank, faced a crisis. The bank, where Barney Frank served on the board, was hit hard. Remarkably, Barney Frank was known for his role in co-authoring the Dodd-Frank Act, a comprehensive piece of legislation designed to address the failings of the 2008 financial crisis. The reason for Signature Bank's troubles lay in its investment in government bonds. When interest rates surged, these long-duration bonds lost 80% of their value. It's an excellent example of how bond prices are inversely related to interest rates. As rates went up, bond prices plummeted, leaving the bank underwater and insolvent. To address the widespread issue of banks holding bonds with reduced market values, the Federal Reserve offered an interesting solution. The Fed announced a facility where banks could exchange these bonds, which were worth less than their purchase price, for loans matching the face value of the bonds. This meant that banks were putting up collateral worth less than the loan amount they received.
So they get bailed out. At the same time, on Sunday night, now we're talking March 12th, they closed another bank, which was Signature Bank. Something about S, Silvergate, Silicon, Signature, all the S's were going down. Now, Signature Bank was another interesting case, which was Barney Frank was on the board of Signature. And if that name rings a bell, just think of Dodd-Frank. Dodd-Frank, 2010, 1,000-page legislation. I know I met Barney. I know Chris Dodd very well. That was supposed to solve all the problems of the 2008-2009 financial crisis, et cetera. Here, the author of the bailout legislation is on the board of the bank, and his bank gets shut down. Well, what's up with that? They bought government bonds, and when interest rates went up from 10-year note, treasury note yield to maturity went from 1 3/4 to 4, all those bonds lost 80% of the value. That's what happens on long duration bonds. Bond math is simple: rates up, price down, vice versa. Well, the rates were up, the price was down, so they were underwater and insolvent, and they got shut down. So Barney Frank's out whining the next day. He's like, "Hey, yeah. But that's true of every bank in the country. There's not a bank out there that didn't load up on treasury bonds at 1 3/4. They're all underwater. They're all insolvent." And by the way, the Fed announced a facility. They always have these 4 initials. I forget what this one was. or whatever. But basically what they said was, if you're a member bank and you have treasury securities that are where the mark-to-market value is below par, so you paid 10 million, but they're only worth 8 million. And that was the case across the board. So they get trillion dollars or more of bonds that were in that category. You can deliver them to us and we will lend you for 1 year the face value. So you're putting up 80 cents of collateral, but you're getting a 100-cent loan. I said, I got a 15-year-old car. Will you lend me what I paid for it? Because it's a lot more than it's worth now. But that's what they did. So now my head's spinning. I'm like, well, I get all this stuff, but I'm like, oh, so you just guaranteed every deposit in the banking system without limit, and you just guaranteed every treasury bond at par value without limit. What's left? Like, what else do you have in your bag of tricks? Because you don't have it. There's nothing else you can do. Go back to 2008, they guaranteed every money market fund in the country. So, but here's Barney Frank whining, hey, yeah, my bank was in trouble, but so was every bank in the country. Why did you whack me and give all these guys a pass? Well, the answer is Signature Bank was another crypto bank. It had a portal called Signet. And Signet was a portal to the crypto world. And that's why they whacked it. Notice they whacked 2 crypto banks. I would say that the Fed's monetary policy will fail or is failing, and fiscal policy will fail. It's in the process of failing, even if gold didn't exist. If you didn't have gold as a multi-millennial monetary standard, even if gold wasn't there as a reference point, which of course it is, but these policies are failing anyway, and there are a lot of reasons for that. Whenever I hear fiscal stimulus, I say, well, no, the Fed can print money all day long and the Congress can spend money all day long, but don't call it stimulus. It's not going to have any stimulative effect. We're way past the Keynesian multiplier, which is now below 1, meaning if you borrow $1 and spend $1, you don't even get $1's worth of GDP. You get some numbers, 70, 80 cents. Forget about the multiplier. It's actually now, a divider or something that reduces GDP. Well, you don't get the GDP for the borrowing. And same thing with monetary policy, because unlike Milton Friedman, the monetarists, the neo-Keynesians, the Austrians, and everyone else, money printing has nothing to do with inflation. And they seem to, well, I don't know if they ever knew it, so I can't say they forgot it. So all the money printing and all the deficit spending will not stimulate the economy. And that's true anyway, but gold is signaling that. Look, all markets try to be forward-leaning. Some do it more successfully than others, more accurately than others, but they try. I would say that, yeah, people say, the stock market is an efficient discounting mechanism for future events, for what they see in the future. And yeah, they look into the future. Here's the forecast. They pick out a discount factor. They present value it and say, here's where stocks should be today, based on where things are going to be, 6 months or a year from now. And that's what they do sort of mathematically and analytically, except they're always wrong about the forecast. You got to get the forecast right if the discounting process is going to mean anything. So markets go through the process, but they always get the future wrong. They're not very good at predictive analytics. So this creates what I call the gap between the perception and the reality. Reality always wins, but not right away. Sometimes it takes a while. Gold, on the other hand, has very high predictive analytic value, number one. Number two, it's more forward-looking. So gold's kind of telling you where things are going to be maybe a year to 18 months from now instead of 6 months from now. And so, so gold is signaling that monetary and fiscal policy will fail and something else will be tried. And that ultimately will result in a much higher price for gold. So gold's just saying, well, let's do it now. Look, I've got gold at $15,000 an ounce by 2025. If I'm wrong about that, it'll be sooner and higher. But that's, well, I consider that a conservative forecast. And we can maybe take a few minutes to go into the analytics behind that. As I've said before, you've heard me say, I don't just throw numbers out there to get attention. I don't really care. I do care about getting the analysis right. And there's a number of different techniques. And what's interesting is they all point in the same direction. So So, it's got to go to 3,000 before it gets to 15,000. It's got to go to 5,000 before it gets to 15,000. So that's my kind of long range forecast. But, it could go down tomorrow. And I'm like, I don't get depressed when it goes down. I don't get euphoric when it goes up. I know where it's going in the long run. That's the important thing if you're trying to preserve wealth and make money. Nothing wrong with making money. I'm all for it. But sometimes preserving wealth, and risk aversion is a higher priority than just making a lot of money in the short run. But either way, gold will serve that purpose and preserve wealth over that time period. Could it go down tomorrow? I guess, yeah. But all the vectors are pointing up very strongly. And I'll give you a concrete example. There are three things that drive the price of gold fundamentally. One you've already mentioned, which is real interest rates. The lower the real interest rate, the higher the price of gold. Number two, supply and demand. You learn it in your first 3 days in economics, but it still works. And then number three is geopolitical risk. Call it risk off or fear factor, whatever you want to call it, but I think of it in geopolitical space. Those three vectors don't all have to point in the same direction. You could have a situation where geopolitical risk is high, pointing to a higher gold price, but real interest rates are really high, and that would point to a lower gold price, et cetera. But right now, all three of them are flashing green or maybe flashing gold. The real rates are coming down. They're still high, by the way. When I always have to just roll my eyes when really smart people, Dan Isaacson, Bill Gross, Jeff Gundlach, and I admire them all and I follow them all. But they've all been carried out feet first on this bond bubble thing, the greatest bond bubble in history, and short bonds, and the interest rates have nowhere to go but up. They're just failing to distinguish between nominal rates and real rates. Nominal rates are low. Real rates are not low. When I say low, I mean, show me negative 4%. That's a low real rate. You can pick your notes or your bills or whatever, but I usually use the 10-year note rate, 10-year treasury, because it's a good proxy for building, construction, long-term investment. People don't borrow overnight to build a building. They borrow for 7 years if they can, et cetera. So to me, that's my proxy for sort of economic growth and inflation forecasting. It's about 70 basis points today, et cetera. But inflation is, 1.5, take your index. So that puts the real rate, maybe negative 25, negative 50 basis points. Well, thank you very much. But, I remind people in 1980, I borrowed money at 13%, but inflation was 15%. And my borrowings were tax deductible, and the tax rate, I lived in New York City at the time, was 50%. So my real after-tax rate was about negative 7. That's a low real rate. So the point is, we have a long way to go. And it doesn't matter, people are interested whether the Fed's going to pursue a negative interest rate policy, take the target rate on Fed funds below zero. Legally, they could. It's already been done in Europe and Switzerland, Japan, and a few other places. I don't necessarily forecast that. I don't think the Fed necessarily wants to go there. But you can have negative yield to maturity on a 10-year note. Just whenever the premium is greater than the present value of the coupons, it's a negative yield to maturity. So you can get there. You can get deeply negative rates in secondary market trading, regardless of what the Fed does. And that will happen. And so, in the DV01, dollar value of 1 basis point is higher as the absolute level of rates gets lower. That's just, duration, just bond math 101. So we're going to have huge capital gains in 10-year notes as the yield to maturity goes, towards negative 1%. But that's going to be an enormous boost for gold. And we're not even there yet. We're seeing we're seeing kind of a spike in gold prices when real rates are still, relatively high. They're only mildly negative. I was declarative when I said printing money does not cause inflation, and it doesn't. Again, I'll just use the last 12 years as Exhibit A. We should probably relate to the viewers what does cause inflation. And the answer is velocity, the turnover of money, the lending and the spending. But the problem is velocity is a psychological phenomenon. The Fed can stick the landing on money supply. They can get it down to a couple of decimal places if they want. But if you want to control velocity, which is the key, that's psychological. So what you have to do is change the psychology. Well, what is the psychology right now? It's deflationary. The savings rate in May was 33%. It had been going up. It kind of made its way like from 4% to 7%, but then it spikes to 33%. Well, savings is a good thing. You can drive an economy if you can convert savings into investment. And furthermore, if the investment is productive, unlike what China's doing. But we got some infrastructure or some other projects, R&D that would be productive. That can drive an economy. You don't have to drive an economy on consumption. You can drive an economy on productive investment. But the problem is twofold. Number one, it has a much longer time frame. That's a 5-7 year time frame. And it comes, in the short run at least, at the expense of consumption. Our economy is driven 70% by consumption. If you substitute savings for consumption, you're killing velocity. Because if I put my money in the bank and leave it there, the velocity is zero. And I remind people, $5 trillion or $6 trillion times zero is zero. You can print all the money you want, but if you don't have velocity, you don't have an economy. And so the question is, how do you change the psychology? How do you get and by the way, it makes sense to save. If you're unemployed, you better be saving because you're maybe lucky if you can pay the rent. But even people who are working or still have their jobs, they're worried, maybe I'm next. Maybe they fired the guy down the hall, but maybe I'm next, and maybe I better save more just in case, and so forth. So, and that's not a bad thing. I'm not saying that doesn't make sense. That makes a lot of sense, but understand what it means. It's deflationary. It reduces velocity. It offsets the increase in the money supply, and it's very hard to get out of. I mean, Keynes called it a liquidity trap, and he was right. That's what it is. So how do you change the psychology? Well, you need something big. You need something dramatic that's going to get people to say, wait a second, what's going on here? Well, one of them would be a $5,000 price for gold.